Welcome to the third and final segment of Buy-Sell Agreements with Mark Zinman and Steven Bowles.
Yeah. So I recommend very strongly no DIY. DIY. I recommend very strongly with you that you would have an attorney. And yeah, it costs money, but pay now or suffer later.
Yeah, it's hiring professionals for their expertise is always worth the money. It is.
And we're not talking about a lot. I mean, when there's not a lot of arguing back and forth and stuff, when it's sort of agreement and documenting, a lawyer can go in and do it pretty straightforward. It's when there's a lot of negotiation going on and maybe different representation, which there would not be in this kind of event because we're all on the same side. You and I are trying to protect our family, so it's not a conflict.
Yeah, handshakes lead to headaches. So we don't want to rely on handshake agreements because down the line that's going to be very that's going to really cause a lot of conflict.
So you mentioned something else. You mentioned that now I have this formula and I should maybe check it every once in a while. So what's who should be doing that? What's a triggering event to the end of the year? It should be your accountant. It should be your lawyer. Who should be doing this calculation to see where we are?
So my general recommendation would be annually. Okay. You should have these things. You have other stuff that you're doing annually, so we're adding one more thing to the list, but we should be taking a look at this annually. And if a professional hasn't looked at your agreements in 5 years, or as you've hit certain growth metrics, like you went from being this little local business, and now maybe you have regional reach, all of those things should sit there. Just like before the podcast, we were talking about having wills reviewed. Right. Well, wills should be reviewed every 5 years or when there's an event. Anything that changes,
I think the best advice for people, and you're agreeing with me, is assume you're dying, permanently disabled, or withdrawing today.
Yes.
And make sure that whatever relates to your business flows exactly the way you intended. And I guess another big triggering event would be maybe the omission of another partner.
Omission of another partner would absolutely, because you might. We haven't talked about this yet, but you might be moving from cross-purchase to entity purchase. You might sit there. Those things can make a difference. The other thing that could make a significant difference would be, well, as the value of the business goes up, maybe you need to structure your buy-sell to be a partnership LLC separately. So it's one of the things that the Connolly case brought to light this last year is.
Explain who Connolly is.
So Connolly versus United States this last year was a big case in the buy-sell world because the court stated that death benefit received by the company actually increased the value of the business. That's not how anybody had interpreted that before. It's not how any attorneys had been operating before. So who does that affect? Well, that affects people as you're settling out an estate. Think of it this way. If your business is a significant asset in your estate, and then all of a sudden at your passing, it's now worth a bunch more, are you now above the exemption for estate taxes, for federal estate taxes? Even more so for any sort of local and state level inheritance tax.
So in other words, another unintended consequence.
It's an unintended consequence. So there's ways around that. There's ways to plan for that. I don't even say around it. It sounds like a loophole, and I hate that term. So there's ways to plan accordingly for that. Partnership LLC has been identified as one of the ways you do that. You have any funding, any life insurance funding that could impact the value of the business owned in the partnership LLC.
So this would be something that a lawyer would.
Correct. Yep. Again, not something you have to sit there and try to take action on from hearing it today, other than saying, hey, I need to talk to my attorney. Do I have an issue because of Connolly? Do I have an issue because we started the business, it was worth $1 million, it's now worth $20 million, and there's two partners, and I have these other assets, and now all of a sudden maybe I have an.
Well, the other thing to factor in is that you don't have to have you have three partners, they don't have to all own 1/3. There may not be equal ownership based on the number of people.
Yes.
And I would think that another best practice is like you should always have a professional accountant, and you should always have a business attorney you can turn to.
Yes.
And that could be for anything. I mean, a business attorney could be used right now for doing your buy-sell agreement. It could be used for reviewing the lease that you're signing on your office or store.
Absolutely.
He may be available, and that having a good business attorney will help trigger that 5 year, the reminders of like maybe need to look at these agreements and make sure they're still valid. And if they're involved in their business, they'll know when there may be a triggering event that you didn't think about.
Yeah, they'll have a finger on the pulse there to say, hey, you guys have gone from this to this. You're now national, you're regional, whatever that versus.
I just want to tell the audience, like, you don't have to like know everything. You just have to know enough to know that you have to hire people to help you know everything.
Have the right people.
Because I don't want somebody to say like, oh my God, like I didn't. How am I going to know when I need to change my agreement? No, you have a business attorney. But in essence, the owners are the ones that control everything. They're responsible. They can delegate the responsibility of formulation to somebody else, but they can't document the responsibility. They can't delegate the responsibility.
Yeah.
It's the same with taxes.
Yeah.
You shouldn't be a victim of your own result.
Correct.
You should. Yeah.
And so on the topic of kind of the different types of buy sells, you have cross purchase and entity purchase are the major two categories.
Define those two.
With a cross purchase agreement, it's best used when there's two partners, where we say, hey, I'm going to buy you out, you're going to buy me out, and I'm going to buy insurance on you so that if you pass away, I get the death benefit to buy you out, and vice versa. Back to the life insurance. So it works great with two partners.
Okay.
Now you add a third partner in. Now everybody's got to own policies on each other. Fourth partner, there's a lot of policies now. So simplify that, you go to entity purchase. Entity purchase says, hey, the entity is going to buy the shares back and then redistribute it to the other partners. And by the way, now we only need to buy one policy on each life if we're going to insure it. So the
one policy or one policy. So just trying to understand, is it one life insurance policy or it's one life insurance policy per each partner and the beneficiary is the company?
It's owned and beneficiary is the company. Owned, paid for, and beneficiary.
So what you're talking about is treasury stock, right? No, what I'm saying is that if I own 50 shares and you own 50 shares,
correct,
and I die, the company buys back my 50 shares. Correct. So now there's only 50 shares left. I still have the same 50, but now because it's 50 over 50, I own 100%.
You own 100%.
That's in my accounting world, it's called treasury stock. So what it is the company buys back. It doesn't have any effect on the partner. We just reduce the number of shares, and therefore the percentage becomes a different from 50 to 100 in this example.
So that's how you can reduce some of the complexity when you have multiple partners with different ownership interests. And even in a simple cross-purchase buy-sell where we're funding it with life insurance, say you and I are partners. If I'm paying for insurance on you and you're paying for insurance on me, is that equitable? I might be less to insure than you might be.
Well, that's one of my other questions. So that's my next question. So you could have partners of different sexes. You can have partners of different ages, and you have partners of different health. So they're not going to get two partners to ever be the same value. How do you make that? How do you handle the difference in cost?
That's where, if there is a discrepancy in that and it's significant and it's measurable, you would go back to the entity purchase agreement and have the company buying the policies on each of them.
So it's more of a company expense,
correct?
Not necessarily an expense for Mark and
correct.
Okay. Yeah. So what are the common mistakes that people make in these agreements that come out?
The most common mistake is just saying, I've got a handshake agreement. You and I started the business. I'm going to take care of your wife. You're going to take care of my wife if something happens, and nothing's documented. That's the number one biggest. Then the next one would be, we do have buy-sell language in there, but we agreed on a valuation and we never updated it. So what happens if there's an event? Well, we agreed on a value. Mark, the business is worth $1 million. We agreed on that. It's like, well, no, it's worth $5 million. What are you talking about? Now you've got conflict. So the number one, those are the biggest mistakes, is either not having any documentation or having documentation that's so outdated.
And I have a client example of that, and I'll share with you. I have a client that has been around for many years, and they have this formula for buying it out. And the formula is retained earnings and another formula, whatever. But basically, the formula is so far below the actual market value that the last man standing is the one that's going to win.
Mm-hmm.
And I think they may realize it. And I brought it to their attention, and they're like, "Oh, we always work this way. We always work this way." But eventually, that's what's going to end up happening. Is that, the company may be worth $20 million, and a 25% interest using their formula may be worth $2 million.
Uh-huh.
So now you have an enterprise value of 8. in the way that they're doing it, but a fair market value of 20.
Yes.
Which means the last person gets 14 million.
Yeah.
Whoever's lasts the longest.
And somebody who thought they were retiring with 5 million is retiring with 2.
Well, they might know they were retiring
difference.
with 2, but they could have retired with 5 is the other way to look
Yes,
at it.
yeah, that's
Yeah.
a good way to look at
Yeah.
it. Yeah, so it just goes back to, you got to make sure that these things are documented and that they're fair. I had a client that we were working on their buy-sell agreement, and they the first thing we did was documentation. Let's get the documentation right. They needed entity purchase, partnership LLC, got all those documents right, everything signed, and one of the partners died. And they died a week before their insurance exam, so we didn't have insurance in place.
Well, I wouldn't pass
But-
the exam then. They're dead.
Correct. Yes, correct. A week before that, they might have. Yeah, if we had
Their health dramatically changed. Yeah.
correct. And but the whole process took them 2 years because there just wasn't good buy-in from all the partners, and it was complex. They owned businesses, real estate, and they owned them all in different percentages. So we had all of this, all spreadsheeted out, and we said we can't do insurance until we have all of this kind of figured out. I mean, we could, but it's not going to be right? So loss of a key employee owner in that situation. The blessing is that we got the documentation done. So now they sat there and they had to settle the estate. It was a significant number. It was significantly higher than what they were telling me was the value of all of those assets, because guess what? The IRS is not going off of that. When you're selling an estate, you got to get the fair market value. And so they got the fair market value. It was tens of millions that were owed to the family, and they had to rely on the installment sale, which was 25% the first year. That's a big number. Big business, big number. So, those are things where it was like the blessing was that the harmony remained because several of them were family members. But if we had just kind of sped that up by a year.
Well, I have a different example. I have an example where I had a client with 5 siblings, and the 5 siblings all thought they were the most important member of the business, and there was a dispute. And so, if you're going to end up having a dispute, the ultimate outcome of those disputes is going to be the buyout of that partner, because you can't resurrect the relationship, right? Well, now without a buy-sell agreement, now they've been litigating for 5 years on the value, and not only litigating on 5 years of value, but then other stuff comes in. Well, yeah, the business is worth $10 million, but you're a minority shareholder, so we're going to discount that.
Yes, yeah.
And you may use discount values in estate planning and stuff, but you're not using discount. You don't want to use discount values in buy-sell because you're expecting a certain.
For lack of control and marketability, which is common in estate planning.
So,
but
unfortunately, this family is spending probably hundreds of thousands, not even tens of thousands of dollars, just all in it to decide who's right.
Yeah.
All, and the ultimate result is going to be everybody. The only people that win in disputes are lawyers.
Correct.
It's a true statement, and And it's the same if it's a divorce case. It's the same in a business thing, and any dispute. Because in the end, the result's going to be the result. It's just how much money you're going to spend to get to the same end result.
And the unfortunate reality in that example is, I'm sure the family harmony. I'm sure they're not getting together. We're recording this in December. I'm sure they're not getting together for the holidays. Now that ship probably already sailed, but now it goes from being conflict to hostile, and we don't want that.
Yeah, and this is an example where it was a multi-generational business, so we're down to the second generation, and then the loss of the parents then triggered less harmony, which then triggered somebody wanting to leave, which then triggered all this problem.
Yeah.
So and not the parents around it, even at their extended age, to maybe just say treat your brother or sister nice.
Yeah, right.
So what did we not talk about regarding buys and sell agreements? What did we miss?
What did we miss? Hopefully nothing. We talked about the valuation.
And the key thing is just to do it. Just formation, operating agreement, buyout agreement.
Yeah.
Buy sell. I mean, it's and what we're telling you, it's just going to be part of the formation of your business. Don't even. It's just like part of that checklist. It's not like a do later.
Yeah.
Because do later means do never.
Do later means do never. Right. Yeah, and then you have to update it. You got to reevaluate it. For example, like what we talked about, the Connolly case came out. All right, everybody that had a buy-sell agreement that predated the Connolly case should sit there and go, does this affect me? and it may.
It's the same thing in estate planning, like if they change the exemption. Like,
Oh, yeah.
like 20 years ago it was 670,000, now it's 13.2 million. So it does change what you do. So
Yeah, and it's going to be 15 million next year, so it changes a lot of things.
I think this has been a great, lively discussion.
Yeah.
I think, it's a great benefit to our clients, and I think that's something that every business really needs to think about and make sure they've done. And if they haven't done it, if they didn't do it in that checklist, today's not too late to do it.
It's one of my favorite topics to cover for a couple reasons. One, it's so common to review them and see issues, so you can truly help people, right? You can sit there and go, hey, this is a gap that you need. And while there can be a life insurance component, it's one of those things where it's like, I can help you with this without it being self-serving, because we may never do a life insurance. Your insurance might be fine. That's great. But if as professionals, if we can bring value in those areas, it benefits the business, and then it benefits the whole ecosystem.
And I know I do, and I'm sure you do. We're sort of in this to help people, right? We want to see people be successful, and that brings joy to us as professionals. Right?
Absolutely, and they take it a lot better sometimes coming from me, because I'm not going to I'm not billable on it. I'm not doing the documents. I'm just sitting there saying, hey, best practice wise, you're missing the mark on this. So let's get that taken care of, and then we get them to the professional, who they may not have enjoyed hearing it from them as much.
Well, I thank you so much for joining me today. I think it's been a great, lively discussion. Thank you.
Thanks.
Stephen, how can our viewers or listeners get in touch with you if they would like to seek your professional advice and assistance?
Sure. So I'm available. My website is catalystadvisory.io.
They should read your vest, right?
That's it. Yes,
Okay.
right there, catalystadvisory.io, and I've got a link on there that people can book on my calendar. And then I'm on social media too, so I'm trying to put out as much of this helpful information as possible. So go on there, learn a little something. You'll see some funny things, some interesting things. You'll see my dog. It's fun.
Like Pudgy.
Yeah. Yes. Yeah.
Well, thank you so much, gentlemen, for all of your insight. We want to thank everyone for tuning into today's episode. Let us know your thoughts down below, and don't forget to like this video and subscribe to the channel. We hope you enjoy the rest of your day, and we'll be here for you next Wednesday.
All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.